Hi, everyone, and welcome to the review problem practice for Chapter 2. We're looking at P230A. Hopefully you tried this on your own already, and you're just coming here to clarify how well you did with it. If you didn't, I suggest you try working on the problem on your own, and then coming back and looking at it and getting an explanation of it. So in problem 230A on page 99, Ann Simpson started her practice as a design consultant on September 1st, 2018. During the first month of operations, the business reported the following transactions. So the first thing they ask us to do is to record each transaction in the journal using the following account titles. Now in your chapter, they talked about something called a chart of accounts. In Chapter 1, you had that beautiful spreadsheet with everything, all the assets, all the liabilities, and all the parts of equity right in front of you. Well, in the real accounting procedures, we don't use a spreadsheet. We use a journal, we use a general ledger, and we use a trial balance. And our first step is what we're about to do, creating journal entries for each transaction. So when you start analyzing a transaction, sometimes we might say, I don't know what account to use. Is it an asset? What kind of assets do they have? What kind of liabilities? Well, a chart of accounts will give you a list of all those items, and that's what requirement 1 does. So this company has the assets cash, accounts receivable, office supplies, a new asset called prepaid insurance, which we'll talk about, land, and furniture. They have 3 liability accounts: accounts payable, utilities payable, where they just keep track of the utilities they owe, and another liability called unearned revenue, which we'll talk about as we're going through the transactions. Then Simpson has a capital account, a withdrawals account. The company has service revenue, salaries expense, rent expense, and utilities expense. So as you're reading through these transactions, you should be referring to that list if you're not quite sure what account to use in a journal entry. Now, remember a journal entry, you must have a date, an account to debit, and an account to credit. You need at least one of each. You could have more, but you need at least one of each because debits must always equal credits in each journal entry. You can also have an explanation, which is just a brief couple words sentence describing the event that happened or caused that transaction. In our requirements, they said not to worry about them. Explanations are not required. So let's start taking a look at these transactions and see how they should be recorded in the journal at Ann Simpson's accounting records, her accounting records. September 1st, the company received $48,000 cash and gave capital to Simpson. You're still going to take the same approach. You're going to say what was affected in this transaction. Cash was affected in the company and capital was affected. You're still going to ask yourself, how was it affected? Cash, let's focus on that. Cash increased. Okay, cash is an asset. And now we go to the rules of debiting and crediting that were presented in your chapter. When an asset increases, we debit it. So on our journal, we'll put September 1st, list cash under the accounts, and in the debit column, put $48,000 to signify cash is going to have a debit in it. Capital is also increasing because in the capital account, we want to accumulate all the money Ann Simpson gives to the company for a period of time. Capital increases on the credit side. It's the rule. Go to your rules of debits and credits. And again, these are presented, just to refer you back if you need it, on page, I usually don't use the book. There's one on page 60 and there's one on page 59, whichever one you like to use more. And that's how you record a journal entry for a transaction. Let's go to the 4th. The company purchased office supplies for $1,200 and furniture for $1,300 on account. So they purchased 2 assets, office supplies and furniture. So there's more of those assets, so we will increase them on the debit side separately. So we'll debit office supplies, so write that name of that account and $1,200 in the debit column, and furniture and $1,300 in the debit column. They purchase both of these on account, so the company owes that money. So they have to increase the liability accounts payable to show that they owe more of that liability. Liabilities increase on the credit side. Now take notice, I didn't mention this in our first journal entry, but the name of the account that is credited will always be indented a little bit. And we usually present debits first and credits last. On the 6th, the company performed services for a law firm and received $1,900 cash. What was affected here? Cash, the company received cash. Why did they receive cash? They performed a service. So service revenue is affected. Cash increases, it's an asset. You debit an asset when it increases. So we'll list cash and in the debit column 1900. Service revenue is increasing as well because we earned more service revenue from performing a service. Revenue increases on the credit side, so we will put service revenue and 1900 in the credit column. On the 7th, paid $18,000 cash to acquire land to be used in operations. What was affected? Well, we bought land, so land with cash. So let's increase the asset land on the debit side, decrease the asset cash, that decreases on the credit side. So land and in the debit column 18,000, then you'll list cash and in the credit column 18,000. On the 10th, the company performed services for a hotel and received its promise to pay $1,200 within 1 week. So the company performed a service, so service revenue is affected, but they didn't get the money yet, so accounts receivable was affected. More money is owed to the company, so accounts receivable has to increase. It's an asset, so we debit it. Service revenue is increasing also because we performed more of a service. We want to accumulate all the charges to our customers in that account, so we credit it. The 14th, the company paid for the furniture purchased on September 4th on account. Well, up on the top, when the company purchased the furniture, they debited furniture to show there was more of the asset furniture and credited the liability accounts payable to show they owed that. Well, now they're paying that. So they want to decrease accounts payable, their liability, because they won't owe that anymore. And they want to decrease the asset cash because that's how they're paying for it. Liabilities decrease on the debit side. Assets decrease on the credit side. So accounts payable debit $1,300. The cash asset decreases by crediting it $1,300. The company paid assistants semi-monthly salary $1,500 on September 15th. So what's affected here? Cash, they're paying cash. Why? For salaries. So that's salaries expense. Now, this is the first expense we're dealing with in a journal entry. And if you look at the debit and credit rules, it says debit salaries expense when it increases. And if you're thinking back to chapter 1, you're like, no, salaries expense decrease. No, salaries expense decrease the equation. What the debit and credit rules are telling us is how to accumulate, or what side to accumulate all the salaries expense on, so we know how much to deduct when we're finished accumulating. So we want to keep increasing any expense account to get the total amount for a period of time. So we do that on the debit side of the expense. So debit salary expense, decrease the asset cash on the credit side. The 17th, the company received cash on account, $1,000. So what they're omitting here is received cash from a customer on account. So those words are being omitted, but that's what that means. A customer is paying us on amounts they owe us. So we're going to increase the asset cash because we're receiving cash, decrease the asset accounts receivable because the customer is paying on a balance they owe us. They won't owe us that after this transaction. So debit cash, credit accounts receivable. On the 20th, the company prepared a design for a school on account, $650. So they performed a service. They have to increase their service revenue account. That increases on the credit side because we want to accumulate all the charges to customers in the service revenue. The company did not receive the cash yet. It was completed on account. So we want to increase the asset accounts receivable to show that customers owe us more money. We do that on the debit side. Continuing, on the 25th, the company received $2,100 for design services to be performed next month in October. Now, so far, whenever we received money from a customer for services, we've already done them. When the company completes a service is when they could call it service revenue. That's not what's happening here. The company's collecting cash and will perform the service later. So we take things one day at a time in accounting. So today, September 25th, we received the cash. We increased the asset cash on the debit side. But we do not increase service revenue. We have not done anything yet. We owe the service. Instead, we increase a liability account. Be very careful with this. This is a liability account, although it says revenue on it. It's an unearned revenue. This is where we store the dollar amount we owe customers for services until we perform them. So we'll increase the liability account unearned revenue for $2,100. Now, if you're saying to yourself, what happens when we perform the service? Chapter 3, we'll look at that. On the 28th, received $2,900 for consulting with Plummer and Gordon. So here's an example of what I was just talking about. We received cash. The company received cash, increased the cash asset on the debit side. Why? We performed a service. Oh, okay, then we could increase our service revenue account. That's why we're getting the cash. The 29th, paid $600 cash for a 12-month insurance policy that starts in October. So on the 29th, we're paying for an expense that we don't start receiving the service related to that expense until next month. When it comes to expenses, normally we receive the service, then get the bill. So we normally receive rental time. We receive our phone usage. We receive the work from our employees. We receive the utilities, and then we pay them. So normally, when we get a bill for an expense, it's from something we already received. We debit the expense, we increase it, and then credit whatever account we need to. That's not what's happening in this case. In this case, we are paying for an expense we didn't receive yet. It's owed to us. This insurance service is owed to us as of today. So we're going to increase the asset account, prepaid insurance, to show that this insurance coverage is paid for and owed to the company. And then we credit the asset cash because we're using cash to pay for it. It's decreasing. Now, if you're saying, what happens when we get the insurance coverage? Well, that's chapter 3. Remember, one day at a time. September 30th, paid assistant semi-monthly salary, $1,500. We've already seen this transaction. We increase the salary expense account to reflect there's more in salaries expense by debiting it, and we decrease the asset cash because we're using cash to pay for it on the credit side. The next September 30th, paid monthly rent expense, $600. Again, paying another expense. Which one? Rent expense. So we want to increase the rent expense account to show there's more in rent expense we paid for. Decrease the asset cash because we're using cash to pay and we're decreasing that account. And we do that on the credit side. The company received a bill for utilities, $350. The bill will be paid next month. So the company received their utilities. That's the assumption. Unless they tell us differently, the assumption is we got the utilities, we got the electricity, we got our bill. So we have utilities expense. We increase the utility expense right now by debiting it. We're not paying for it today, we owe it. So we want to increase our liability account, utilities payable, to show that we owe this, and we do that on the credit side. The final transaction is Simpson withdrew, so the owner withdrew cash of $3,700. Well, we have a special withdrawals account where we keep track of all the money Ann Simpson takes out of her business. And every time she takes more out, we increase the withdrawals account. So we know the total amount that she took out. We do that on the debit side. Since she took cash, we want to decrease cash. It's an asset. Assets decrease on the credit side. So that is how you approach doing journal entries, step by step. Eventually, you'll just look, the more you practice this, you'll just look and go cash credit, because you've just went through those steps so many times you start skipping steps. But I would suggest that you use those steps in the beginning and keep practicing them, because if you can't debit and credit, you're not going to be able to proceed through this class or Accounting 112. This is accounting, okay, and you must tackle this and get these rules and really make them a part of you for the rest of your accounting education. So we are done with the journal entry step. It's where we create a journal entry for each transaction. The next step is posting each one of these journal entries to the affected account in the general ledger. Remember, the general ledger are all of our T accounts, and that's what I generally use, our T accounts. So before in our spreadsheet, each asset had a column, each liability, each part of capital or equity. Now they have a T account, and each T account you could think of as a page in a book, and the title of the book is the general ledger. I call it the mothership. It's like the center of our accounting universe. All transactions must flow through the general ledger. So every journal entry we do must be transferred into the respected T account in the general ledger. Let's take a look. The very first journal entry we had on September 1st. So you should have your journal entries to the left of you and your general ledger to the right of you, if you're doing this as we go. And you should say, okay, my journal entry on September 1st, it says in the I should debit cash. So remember, debits are on the left, credits are on the right of every T account. That's the definition. A debit is the left side, a credit is the right side. Now, if the journal entry says $48,000 on the debit side of cash, that's what you do in the general ledger. If it says $48,000 on the credit side of cash or capital, that's what you do in the general ledger T account. And you'll see that reflected there. Do not know if you could see my pointer or not. Let me see if I can do anything here. I don't want that. I don't want that. Let's see. I might be able to do some stuff here so you can see at least my highlighter going over it. The next journal entry happens on September 4th. And look at your journal. It says on the debit side of office supplies, $1,200. On the debit side of furniture, $1,300, and that's what we do. On the credit side of accounts payable up here, $2,500. Notice the dates are next to it so we know when that journal entry occurred. On the 6th, on the debit side of cash, $1,900. On the credit side of service revenue, down here, $1,900. Yeah, let's try and see what happens. Woo! Okay, I got a pen going on. On the next one, the 7th, on the debit side of land, right here, I put a little dot there, $19,000. I'm going to go back to my little highlighter pen. On the credit side of cash, $18,000. The next one, debit side of accounts receivable on the 10th, $1,200. Credit side of service revenue, $1,200. So you just go to those T accounts, transfer that amount with the date. The next journal entry. On the debit side of accounts payable, $1,300 on the September 14th. On the credit side of the cash T account, put $1,300 and the September 14th. On the 15th, debit side of salaries expense, $1,500. Credit side of cash, $1,500. On the 17th, debit side of cash, $1,000. Credit side of accounts receivable, $1,000. So we're just transferring. The 20th, on the debit side of accounts receivable, there it is right there, $650. Credit side of service revenue, $650. The next, on the debit side of cash, $2,100. On the credit side of unearned revenue, this is the September 25th, $2,100. On the 28th, the debit side of accounts debit side of cash. Debit side of cash, $2,900. Credit side of service revenue, $2,900. The 29th, debit side of prepaid insurance, $600. Credit side of cash, $600. The next journal entry, debit side of salary expense, $1,500 on the 30th. Credit side of cash, $1,500 on the 30th. Next one, debit side of rent expense, $600 on the 30th. Credit side of cash, $600. The third one on the 30th, the debit side of utility expense, $350. Credit side of utilities payable, $350. And the final journal entry was on the debit side of withdrawals, $3,700. Credit side of cash, $3,700. So what you just did was post each journal entry to the general ledger. The next step is to find one balance in each account, and here's how I tell students to do that. Start with your cash account. Add up all the dollar amounts in the debit side. $48,000 plus $1,900 plus $1,000 plus $2,100 plus $2,900. And on a piece of scratch paper somewhere, you could write it down. My debits equaled $55,900. Now go to the credit side. Add up all the amounts in the credit column of cash. $18,000 plus $1,300 plus $1,500 plus $600 plus $1,500 plus $600 plus $3,700. And the credit side amounts to $27,200. Subtract the smaller total from the larger total. So the larger total was $55,900. Subtract the $27,200. The balance of cash is $28,700. It goes on the debit side because that is the side that had the larger total. And that's how you can go about determining the balance in a T account. Accounts receivable. Debits are $1,850. Credits are $1,000. The difference is $850 on the debit side, and you can see it says BAL there to represent balance. Some accounts only have one transaction in them, so we rewrite the dollar amount, and that is the balance. That's so for office supplies, prepaid insurance, land, and furniture. Going up to the top, now let's look at our liabilities. Accounts payable, $2,500 on the credit side, $1,300 on the debit side. The difference is $1,200. The balance will be on the credit side, the larger total side. Utilities payable, unearned revenue, and capital all have one transaction on the credit side, so that will be each of those accounts' balances. Simpson withdrawals is a debit balance. Service revenue, there's 4 different credits. We add them up. The total balance in service revenue is $66.50. Salaries expense, there are 2 transactions in the debit side. Add them together, $3,000 is your balance. Rent expense and utilities only have 1 transaction, so those are those account balances. So again, our first step is take each transaction and create a journal entry for each one. When we are done with those for a period of time, we then transfer or post each one of those journal entries to the respective account in the general ledger and find a balance in each account. The third step of really transforming that spreadsheet into the real accounting system is creating a trial balance. A trial balance is a list of the accounts with their current balance. A list of the accounts with the current balance. It's done for 2 reasons. It's one, to give us just the summary information that we collected in the general ledger. And more importantly, it's used to prove debits equal credits. So, Ann Simpson Designer trial balance, and it would be dated September 30th, 2018. It only has 3 columns, an account title column, a debit, and a credit. So what you do, and I can't go backwards, but you would use each T account and its balance to create this. So you use the general ledger to create the trial balance. So you'll list cash with this balance in the debit column of $28,700, accounts receivable with its debit balance of $850, office supplies with its debit balance of $1,200, prepaid insurance, $600 debit balance, land, $18,000 debit balance, and furniture, $1,300 debit balance. All the assets are grouped together, listed first with their balances. We then go on to the liabilities in our general ledger. Accounts payable has a $1,200 credit balance, so we make sure we put that in the proper column. Utilities payable balance is $350, and unearned revenue was $2,100. We'll then list the balance of capital on September 30th from the T account, $48,000. Credit. Be careful. We're so used to going through credits. When we get to withdrawals, I always used to do this, I'd accidentally put it in the credit column. No, that is a debit balance. Service revenue has a credit balance of $66.50 in the T account, transfer it over, and then each expense balance is transferred over into the debit column. So now we have all of the general ledger book information in a very summarized format with just the balances. Add the debit column, add the credit column. They must equal. If they don't, you've got to find out why. So again, in Chapter 1, we had a spreadsheet. We've converted that spreadsheet into a 3-step process, which is how we really do accounting. We create journal entries for each transaction. We transfer and collect information related to one type of item in the general ledger T account, find balances, and then create a trial balance, which is just a listing of all those accounts with the balances. Now in your problem, that's where they stop. I'm going to take it a step further here because this is what we use to create financial statements. So I want to go through and create the 3 financial statements that we learned back in Chapter 1 for Ann Simpson. Using the information from this trial balance. Now I'm not going to be able to flip back and forth. So you're going to have to make sure you have a trial balance in front of you as you're going through and looking at this income statement, statement of owner's equity, and balance sheet. But let's take a look. Ann Simpson Designer income statement. Since this is information for the month September 30th, month ended September 30th, 2018. Remember, the only 2 types of items on an income statement are revenues and expenses. The service revenue account on our trial balance is $66.50. The expenses, salaries expense, rent expense, and utilities expense are all listed. Now, one very important thing to do that people usually start confusing here is they go, oh, there's two columns. One's a debit column and one's a credit column. No, not on a financial statement. You could do one of these back in chapter 1 before you even understood debits and credits. It's just the way it's presented because we collect the detail of the expenses on the inner column and just bring the total out in the outer column. That's all. So we're going to total up those expenses, subtract them from the service revenue to get the net income. Double underline. The next financial statement will be the statement of owner's equity. Remember, that's also for the month ended September 30th, 2018. Capital, Ann Simpson, September 1st, starts at 0. She's just started her business. Contributions from owner, $48,000. We already determined the effect of revenues and expenses, which was net income for the month of $2,700. So remember, the only items that could change owner's equity are contributions from the owners, withdrawals from the owners, and net income or net loss, revenues and expenses. So we've accounted for 3 of the items, the contributions and the revenues and expenses so far. They total $50,700. We then subtract any money Ann took out of the business. We kept track of that in the withdrawals. So let's subtract the $3,700. Capital, Ann Simpson on September 30th, $47,000. Double underline. The final financial statement is the balance sheet. Remember, a balance sheet is as of a specific date, September 30th, 2018. We're going to list the assets, liabilities, and owner equity balance as of that date. So we transfer from our trial balance each asset with its balance. And then we total them. Total assets, $50,650. We then do the same thing with our liabilities. Each liability is listed. Remember, unearned revenue is a liability. It is listed on the balance sheet with all the other liabilities. In chapter 1, we had no liabilities, right? Now we have 3. List each one and add them up. Then we list owner's equity. The capital for Simpson, we determined on that prior statement, the statement of owner's equity, $47,000. Add your total liabilities to your owner's equity, $50,650. Assets equal liabilities and owner's equity. So just another review of those financial statements. You want to keep reviewing them and reviewing them and reviewing them because they don't go away. That's why we're here. Okay, so that concludes our review of Practice Problem 238 on page 99. If you have any kind of questions, please post them to the discussion board.